our channel Talk of Town. We are today kickstarting another new series on the markets. This will be a weekly series where we'll be discussing on global markets, the events that happened through the week. We'll touch upon both fundamental and technical aspects of the markets. To discuss this, I have with me Mr. Prabhanjan Rao, a SEBI registered investment advisor, and Ashwin Kumar, director of DAA Capital. I welcome you both to this episode.
Good morning, Helen. Good morning, Ashwin. It's pleasure to be with both of you as always.
Thank you. The feeling is mutual, and considering where the markets are, I think I feel all the more happy.
Oh, what a week it was! I
Absolutely.
think across the globe we have seen rallies across major indices. And I would love Mr. Prabhajan to take over to kind of give us an insight on the macros of the global markets for the week that we concluded on 27th June.
Right. Thanks, Ellen. Before I, take on to this, I just wanted to say something. The channel Talk of the Town has growing a lot of popularity in UAE and also in Ghana. Because yesterday, when I was talking to some of my colleagues, they were watching this channel, and then they were saying, what happened to this month weekly this month updates. So that means, I was so happy to hear that the channel is growing. So all the best to Helen. So all the best to all of us.
Thank you so much.
So
That's good to hear.
great, great. So, Ellen, coming back to your questions, as what a week it was, a lot of macro events that has flared out. And I would like to categorize these global events under three major categories. One is the impact of war, then is the tariffs. Of course, the tariffs have started much before this month, but this tantrums of July 7th still lingers around us. The third one is the US inflation data and Powell's comments. So these are the three major events that has flared out in the last a month or so. And to come back to the first thing, the impact of war. Yes, indeed. 2025, if we see India, the entire globe is going through a lot of war scenarios. We just concluded India-Pakistan war. Then Israel Palestine war is still going on. We had concluded the war of Israel and Iran.
Yeah.
Then of course Russia and Ukraine. So on the global events, any war that has connected with oil producing countries have a long lasting impact. On the recently concluded war, if we talk about what has happened is the oil suddenly it surged by 11% of the after the Israel strike on Iranian facilities, but it pulled back sharply 6 to 7% once the things have returned to normalcy. And today, as I'm talking about, the crude is about 67%, which I would always say to India, to all any of the crude importing nations, 67 crude is still bad. Anything for India, if it is about $55 to $60, it is really good. And the dollar index is at a pretty good levels. It pulled back to 97 levels from the where it was 103 levels to 97 levels. It is pretty good. And the VIX, if we talk about the CBOE index, the US VIX is about 16.3%, and India VIX is 12.7%, which is pretty good. Anything to me, any less than Indian VIX below 14 is a pretty good index, pretty good indication. To talk about the USD dollar index, 10-year GSEC is about 4.27%, and 30-year yield is about 4.8%. And because of the impact of the war, the gold has climbed, which is always considered to be a safe haven. It has climbed at all its peaks. And if I talk about the levels on an ounce level, per ounce it reached to 3,270 to 3,280 levels per ounce. So per gram, it is about $105 per gram. So all these things, what it says to us is global economy has become very volatile. Unlike in earlier, like 10 years, 20 years back, any small incident that takes place, lot of these triggers, whatever parameters I spoke, they get into action. And every country is one way or the other way connected with these parameters. Now, coming to the tariffs, of course, a couple of months back when U.S. president has imposed these tariffs, it has brought a lot of instability to the entire value chain in the system. In fact, I always kept on saying that these tariffs will bring a course correction in the entire the world in the supply chain logistics. So when we say when we are talking about course correction, what it impacts, what it means of a course correction, which will also have an impact on developing countries like India, is the US, which is the mother of all markets. The inflation levels, which they were typically talking about 2%, I don't think in the near future they can ever go back to that 2%
Yeah.
because of these tariffs. Similarly, the the US bond yields, which was typically between the range of 3.5%. Now it is at the range of 4.5%, and I don't think it will come below 4% in the near future. So these are the course corrections, and now we have to live with this. These are the near new norms that has been set by this, by this government. So because of this impact in tariffs, the short term, what I always feel, sorry, is that the US GDP will be slowing down to 1.3% in 2025, and I personally feel that there is a 35 to 40% chance of recession, which might come in H2, but it will not long last. It will not last long.
Understood.
Similarly, there has been a survey of 465 CFOs, which says, sorry, I've been suffering with a cough and cold. So I was saying, like, there is a survey of 465 CFOs that has been done, and they all say that 40% of the companies, their CFOs have opted that uh, the tariff, because of these tariffs to the customers, 40% has been postponed the investments, 40% has been passed on these tariffs, right? So 60% has not been passed on, the companies are absorbing. So it is a double-edged sword. If it is passed on to the consumers, it's an inflation. If it is with the companies,
The
what it
margins will grow.
flares is the profit levels of the companies will come down.
Yeah.
So this has a double-edged impact. And also the JP Morgan warns that the tariffs has blown up the post World War II scenario, and the global forecast is up to around 2.9% in 25-26. So these things have got a long lasting impact. And the third one, which is the third important point, which has flared in the last 2 weeks, is the inflation data on the and Powell remarks on the rate cuts. The CPI inflation in the US is about 2.4% in the May, and which is up from 2.3%, very marginal. But as I said, I don't think in the near future we will come back to US can come back to those two levels because of the course correction which is happening, and the core inflation levels remains elevated between 3 and 3.5%. That is what is projected by the year end, and Fed has reaffirmed that the rate cuts will be very unlikely before September, and the currency policy rates is somewhere hovering around 4.25 to 4%. And of course, as I said, like when there is a course correction, this inflation and interest rate risk will always get adjusted. So this is what are the global scenarios that has flared out, which will have a long-lasting impact, and also there are certain factors which has a very short-term impact on the markets.
Got it. Got it. I mean, too much of data points for us to pick up across the globe. Before we get into the domestic factors with respect to Indian markets for the week, I would like to move on to Ashwin if you have any inputs on the global markets for the week that we concluded from a technical perspective.
Uh, Lakshmi, see, the fact is that we have the global markets, especially the US and of course followed by India, have rallied on the back of a war. Is a major shift in how the markets are behaving. So, I mean, even during an ongoing war, the market movement is undisturbed. I think somewhere we'll have to realize that the money flow is too much in the market for it to fall. But all these data points, I always, this is good to analyze, but all these data points, I always take it with a pinch of salt.
Yes.
I always believe that there are bigger market players who set things up and can trap you, the retail investors. But having said that, I do not want to be too paranoid about it. I always like to go by what the chart is indicating. The volumes and the price movement are supportive of each other and they're complementing each other. And as we speak, I was just looking at the chart of S&P. I mean, look, in the last couple of probably one quarter, we have rallied almost 27% on S&P. We are not too far away from the lifetime high, and so is the Indian market. So predominantly from the US markets, things are good, especially the tech stocks are doing extremely well. What changed to a bearish stance is suddenly moving back to neutral and then coming to a bullish stance on the larger time frame. And many of the stocks have actually crossed the previous lifetime high. That's a very good sign. So the momentum will continue, at least because we're talking about the week ahead. I believe the momentum will continue for the next 1 week to 10 days. Gold, of course, is on a cool off phase. I do believe it's really necessary. You just cannot go on and on and on because the wire will snap someday. But as long as it cools off by good 4-5%, it's a healthy correction, and I truly welcome it. And for all those people who are short-term traders and who might have missed on that last leg of euphoric rally, will definitely be watching out those levels to jump into gold for a short-term gain. Silver, of course, like I've always been telling you, Lakshmi, on a personal note, we are not too far away from testing the 2011 and 1980 high, which is close to $46. Although it's still about good 20-25% from here, but we are inching towards it. That's the level I'm very keenly looking to eye for on the silver, and when it comes to silver. And of course, like you said, we'll talk about the Indian markets a little later. But on the global front, I'm not seeing too much of a scare right now, at least for the next 7 to 10 trading sessions. So I think I'll stay put on the long side.
Great, great. So one important data point which most of you would have come across is this major news being circulated that in Indian markets, so DIS is greater than FIS today, right? That's something which has is in circulation over the last 1 week, 10 days. So Prabhanjan ji, over to you for the fundamentals on the Indian markets for the week concluded.
Yes, you're right. I mean, gone are those days where we were excessively dependent on the FIA's money inflow. Now, um, even though the entire turbulence in the global markets and also in the Indian markets, why do we think that the markets have not crashed like COVID levels? It's only because of the domestic institutional investors who has been stacking on the cash, and they have got. I mean, the SIP levels, though it has calmed down a bit, but it is going to go up, right? And also the education levels of the retail investors has kept the markets. I mean, people have. Has been a substantial change in the investor behavior. There's a substantial change in the domestic institutional behavior. So the Indian retail investors and the domestic institutional investors are holding on to the markets. But yes, we can't ignore the FII participation, though. In the short run, they are running the show, but in the long run, the equation will shift towards the domestic, both in terms of the retail investors and also from the what do you call it as the foreign, domestic institutional sector. So it will take a bit of time. So to talk about what are the things that has flared in the last 1 month, which has given this liquidity rush to the entire Indian markets, is again I would categorize these three things in under three main categories. One is very recent, that is the trade deal that has happened. The US on Thursday announced that it has signed a trade deal with China, and China also has confirmed it. And he also has hinted a very big agreement with India, which will follow very soon. So these are the two trigger points which has rallied the markets in the last 3 days. Because it improves the global sentiments between US and China, US and India, which are the three biggest, largest economies in the world now. And second thing which I would always say is the RBI stance. So RBI, I mean, the RBI's aggressive front-loaded approach has really, acted as a catalyst to the India's growth story. Uh, with three rate cuts, slashed CRR rates, bond buying, which I'm going to talk about it on the OMR purchases, how much liquidity it has infused on the OMR buying. They have sent a clear signal that the focus now is on the growth. So, with inflation well contained, the stance shift to neutral from accommodative indicates that RBI is on an aggressive front loaded approach towards growth. To just touch base on the rates, how it impacts our Indian economy, for in the interest of the viewers is, let me read out the rates. I just made a few notes on the rates. The repo rate is about 5.5%. It has been cut by 50 basis points on the June 6th, and YTD it is 1% that has been cut on the repo rate. The reverse repo, which we generally call it as a standing depository facility rate, which is hovering around 5.25%, which is 25 bips below the repo rate. There is a spread of 25% between the repo and the reverse repo rate, which is quite healthy. And the MSF and the bank rate is about 5.75%. And the big boost that has come from the Reserve Bank of India is a 1% cut in the cash reserve ratio, which has been cut from 4% to 3%. Of course, this will be done in four tranches starting from September 2025. And the point here to be noted is this CRR cut of 1% will induce a liquidity release of 2.5 lakh crore by the end of November 2025. Now, if I can just touch upon for the interest of the viewers, what these parameters means for the banks, for the customers, for the depositors is, for the banks, the CRR cut has induced 2.5 lakh crore, as I told you, which will be used by the banks for the lending or for the investment. Second is the cheaper borrowing from FY25 on the repo rate reduction. They have reduced zero point 0.5 basis points, and YTD it is 1%. So what it entails for the banks is it reduces the bank's carrying cost because it's a cheaper borrowing from the RBIs. And also, the Reserve Bank has made one strong recommendation to all the banks is to pass on these rate cuts to the to the public. So earlier, when there has been a rate cut, the banks were very reluctant till they strengthen their balance sheet. They never used to pass it on, except the public sector undertakings. But now, what has happened is it RBI is actively participating and urging all the top private sector banks and the PSUs to slash the deposit the lending rates. And if you see the weighted average lending rates on the new loans has fallen by about 6 basis point, 0.6 basis points. So, and what it takes on the bank's balance sheet because of this liquidity rush is, with this liquidity rush, about 2 lakh crore in the SDF balances, and it really reduces the liquidity stress from the bank's perspective. And durable liquidity supports smoother asset liability management, and it really ensures the lending, the banks to focus on the lending rather than on the deposit mobilization. If we see last 6 months, every bank was running behind depositors because depositors were closing the deposits prematurely and putting onto the stock markets. Now they were really running after the depositors. Now the things have changed. Now the banks have started concentrating on credit growth because of the liquidity what they've got it. So this really helps the banks to improve the liquidity, credit growth in the economy. And this RBI stance, what it means for the customers is, of course, number one, the cheaper loans in FMCG sectors. in auto, personal, and MS, and of course, even on the MSME loans, it will have a long-lasting impact. So, such loan affordability increases the home loan borrowers as well. So, FMCG home loan borrowers really will have a lot to spend on the table. And what it impacts the depositors, of course the depositors will never be happy, because the deposit rates have already started coming down. And one interesting thing here to notice, the local deposit rates have started falling, and it really matches now with the FCNR rates, the dollar deposit rates, which is directly talking to the the 10-year yields or 30-year yields of the US. So that one course correction will happen in next, to me I think maybe in 3-4 quarters, even the FCNR rates also will start falling down. The third one, which is the most important, is the OMO. To just in the interest of the viewers, let me explain how OMO and what OMO is. This is the open market operations by the Reserve Bank of India, which is a key monetary policy tool, uh, which it uses to manage the liquidity and control the interest rates in the economy by selling and buying the bond markets from the which are available with the banks. So, to give you a small statistics about how it has impacted the liquidity and the interest rates in the economy, RBI has brought about 2.45 trillion between March and May, and analysts expects that by the end of FY26, the OMOs to reach 4 trillion, which is actually sucking the liquidity. And of course, as I said, the OMO operations from the banks always acts as a tool to control the credit or to expand the credit. And uh, because of these OMO operations, what are the sectors that will get into is, of course, the housing, the MSMEs, infrastructure, and the consumer durables. So these three things which has happened has improved the credit liquidity in the economy at the domestic level, and this is also, to me, will continue, and the benefits of this liquidity will continue in the next 1 or 2 years. So that's what has triggered the fuel in the markets.
Wonderful, wonderful. I'm sure I'm able to correlate the various aspects you mentioned on the RBI policy, the kind of OMO operations, and these would definitely reflect in the charts, right? So, Ashwin, I know you're smiling. Over to you on the technical side for the Indian markets.
Right. So, like I always say, charts never look at the reason, they just indicate what's happening in the market. I too was very curious to know why the markets move that way. And thanks to Prabhanjan, so he complemented the charts very well. Coming to the charts, Lakshmi, so the week that just ended, we saw some construction and the manufacturing sector, as well as the oil and gas sector, do extremely well in the last 1 week. There were definitely a few laggards, but in the last 10-12% rally of the markets, the sectors have been, the movement has been cyclical. By the time you realize that this is the sector that is going to move the market, there's another sector that is taking the markets high.
Yeah.
If you just look at the Nifty 200, I mean, let's for a minute move beyond the Nifty 50 and look at a Nifty 100 or a Nifty 200. It's not particularly a broad market rally. There has been a sectoral rotation, as well as a very few stocks, heavyweights moving the market. And like I say, that's the nature of the market. Every time we look at the charts, every time there is an uptick, there need not necessarily be that that all these stocks are moving. Uh, the unfortunate thing for many investors is that if they are in the habit of comparing their portfolio with an index, the index has moved up, but unfortunately they are not owning the stocks that that moved last week. But it's fine. This is the time where market tests your conviction on the stocks that you're holding. You cannot be shuffling stocks every week or every month just because it's not catching up. Eventually, if you have the conviction in this stock, I think we just have to stay put, unless and of course there's a major fundamental shift. For the week ahead, if I'm talking about the two big boys, one is Nifty. I was just analyzing the open interest. So we have a major call selling coming in at about 26K. and on the downside there's massive put selling around 25,500. So next week I expect the market to be range bound between 25,500 and 26,000, which itself is about a good 2.5 to 3% range. And what is going to be sluggish is Bank Nifty. It has been the leader in the movement. It is actually trading at lifetime highs. And if I can be a little technical here, I'm on the shorter time frame. I'm looking at a very something sort of an ending diagonal pattern wherein it's getting a little congested for the index to move higher. But apart from that, I think the last week the sectors that have moved should continue their run if the markets have to stay afloat. But like I said at the beginning of this session, all these data points is just a navigation tool. I always take them with a pinch of salt. One news, good or bad, that comes in, everything can change. Because when I say 26,000 and 25,500, traders can always shift their preference or the strike price. So that's where the market outlook changes. But for now, to start off the week, I am looking at the 25,500 and 26,000 as the major support and resistance for the big boy Nifty.
Wonderful, wonderful. I mean, it will be interesting to know a view on Bank Nifty as well. You did mention you did mention about ending diagonal, but do you have any specific data points on Bank Nifty?
Bank Nifty, see, again, when I say ending diagonal, I do not want to construe that, okay, there's going to be a major reversal, we're going to be down 10% in one quarter. I just feel the movement is sluggish. The patterns are, maybe, and you're seeing that not many banking stocks are contributing to the movement. That itself is a first and advanced indicator that you're almost making it to the top. And when I say suddenly I do not want to turn bearish, I might say with being absolutely bullish, I want to include the neutral stance as well. Uh, which, if you want me, knowing Lakshmi, he will say, I want you to be very, very specific in what you're saying. For an upside of 2%, I'm expecting a downside of 5 to 6%. Not necessarily in the next 1 week, maybe in the next 2 to 3 weeks, let's say about a month. So that should complete the healthy correction of the rally that we saw since the bottom that we made on the so-called Liberation Day, the Trump trade announcement. Uh, Look, I think one thing I want to be very clear about for all the for our understanding is the recent rally has not been supported by the broad market rally. It's only a few handful and sectoral rotations that have taken the market higher. While from an index perspective, we are not too far away from the lifetime highs that we made in September of 2024. Many stocks are down even 30% or 40% from there. They're struggling to recover. That always gives me a sense of warning that everything is not too well in the markets. It's kind of a push and pull scenario. The macros and the micros are trying to fight out each other, but eventually, like Prabhanjan initially said, the money flow is so much in the Indian markets today that we are balancing it out. So even I was told by one mutual fund a friend that the redemption requests are being met by the cash flows, and fund managers are not really under pressure to exit these stocks, and that's why you're seeing under any negative scenario the markets are holding up. So we don't know the real picture behind it, but the fact is that the Indian markets are the strongest in the globe. And any market that is trading at lifetime high, I always treat it very, very seriously.
What is more interesting is after many months, after many weeks, this slowly the cash portion on a lot of big mutual funds is again back.
In fact, to add to it, not just mutual funds, I've been I'm very keen follower of some of the top PMSs in the country. The 10 to 15% cash came down to single digit, and in the last 45-60 trading sessions, it's less than 3-4%. So they are completely deployed, and these guys have in their good have a good resource to analyze the data points, and when they are going with complete they're completely deploying into stocks, I think they're quite confident about it.
Yeah, I'm talking about some of the large mutual fund schemes, largest in the country today. The cash portion is again increasing; it's going up. So does it?
Oh yeah, yeah.
Yeah,
It's
does
it's
it
quite
mean?
contrary as well. Yes.
Yeah. So does it mean there is little bit of uncertainty creeping in? Only time will tell. For
Yeah,
that, I think it's important for us to get into our next episode, which is going to be a week away. This is going to be a weekly series. And an important announcement before we conclude, that this discussion is purely educative in nature to give you perspectives on both fundamentals and technicals, does not constitute any investment advice. Please do consult your financial planner before making any investment decisions. Thank you, Prabhanjan, and thank you, Ashwin, for being with us. See you next week.
Sure.
thank you,
Thank you so
gentlemen. You
much,
have a
as
good week
always.
ahead, and I wish our viewers the best week ahead.
Yeah, yeah, and thank you always. I mean, as always, it's a pleasure having a talk with on the talk of the throne to talk to both of you. It's always a pleasure.
Likewise.
Thank
We'll
you.
see you next week.